From the morning reading, stocks soar. Bank of Japan follows ECB and lowers key rate to negative. Microsoft, Qualcomm, Intel, Apple, Cisco, and Facebook lead the tech sector. All 9 sectors moved higher on Friday. XLK, XLE, XLB were the strongest sectors, while XLY was the weakest sector. Oil rose 2 cents to close at 33.74. Breadth strengthened as advancers led decliners 8.08 to 1 on the New York Stock Exchange and 3.86 to 1 on the Nasdaq. Falling bond yields boost utilities. AT&T hits record high. Food stocks lead consumer staples. Dollar weakens with short-term rates. Dow bounces on rising crude. Bonds and utilities are rising together. With a 10-year Treasury yield slipping back below 2%, bond prices are rising. The daily bars show that the Barclays 7 to 10-year iShares IEF nearing its January high. Rate-sensitive stocks like utilities usually rise right along with bonds. The utilities XLU surging today to a 3-month high. Lower bond yields also benefit other dividend-paying groups like telecom, REITs, and consumer staples. Lower bond yields increase the appeal of dividend-paying stocks. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:02 a.m. Central Time, and I'm recording this in preparation for the market day of February the 1st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. And action pretty negative last night. Coming into this morning, we still have an hour and a half before the cash open. We'll see what the cash and all participants do with this, but pretty negative coming into this. At this point, the S&P futures are down over 15 points, over 0.75%, giving back a good chunk of Friday's bullish action. Russell futures are holding up better. They're only down less than 1/3%. Nasdaq futures are down about 0.75%, as are the Dow futures. Crude oil down big, down over 4%, $1.36 at the time of this cut. The euro is up about almost 0.5%. Bonds are up about 1/4, and gold is up about 2/3%. And overseas action, kind of mixed. You have China down 1.78%, Hong Kong down about 0.5%, but going in the opposite direction is Japan, up almost 2%. Germany also down over 1%, as is the United Kingdom. In terms of macroeconomic reports for today in the United States, we have personal spending and core PCE price index. And we have ISM manufacturing during market hours, so be aware of that. That could reach up and get you in the middle of your intraday trading. We do have, in terms of overseas action, Draghi, the president of the ECB, speaking, and we also have one of our own FOMC board members, Fisher, speaking later today. So that could also rile things up, so be aware of that. In terms of current volatility conditions, things have come down quite a bit. The short-term VIX is now down below 20. This was well up over 25 not long ago, even pegging 30 not too many trading sessions ago. You notice the skew also down below where we call kind of a cautionary level, and is approaching more normal kind of levels. IV percentile for the S&P, a very low 28. For the Russell, a 35, for the Nasdaq, a 35, and for the Dow, also in that very low area at a 33. We did have multiple standard deviation moves put in on Friday, with the Russell and the Dow putting in 2 standard deviation moves, and the other 2 putting in single standard deviation moves. Most importantly, of course, those were bullish moves, so that was significant in its action. We'll go ahead and go to the charts now, and you can see on the SPX just how big a move that is. I mean, that's as bullish as it gets, where your open is the low of the day and your close is the high of the day. There is no wick at all on either end. So very, very significant action, but perhaps far more significant is the fact that it broke out of this trading range that it had been in. You see all these large bodies especially, and you know, it not only broke, but broke convincingly. Volume was moderate. You know, you'd love to see even more volume on a breakout like this, but it also wasn't low enough to where you would make a big deal out of that either. So, frankly, bit of a surprise here for me. I would have kind of put about a 2/3 probability that it would have broken to the downside out of this pattern. But price action is what matters, and this price action has broken out to the top side. So for right now, we have to say that risk levels are coming down. We'll go to the daily report in just a second, and that the short and starting to bleed into more intermediate term patterns are starting to be more bullish. Now, in terms of where this goes, we'll likely come up here into this area right here. You see the bottoms of all these wicks, this action here, about 1990 to 2000. We'll likely see this action come up into this area and probably be some resistance at that point. Now, that said, I mean, there's a whale of moving average lines, Fibonacci extensions, prior support now turned into resistance. When you're coming up off a bottom like this, you have to fight through like a phalanx. I mean, one line after another of resistance that's going to be pummeling you as you try to grow up through this area. You also have this open gap here at 2044. So if we do get past the roughly 2000 area, it would likely run up into this gap here. So it's possible that we could see action that could take us another 100 points up. So we have to hold that out as an open possibility. So if you're still holding a lot of bearish positions, that's a rather tenuous position at this point unless we break the low of this big candle. If we break the low of this big candle, then we probably are going back to the lows of the swing pattern down here at the 1812 area. But and even right now we're down about 15 points, but a retracement down to halfway through this body before resuming this bullish pattern would not be unexpected and would not damage this short-term trend and breakout. If we were to come back and close back in this prior chop, that would be very, very disappointing for the bulls and would certainly weaken this pattern significantly. So I would, first of all, look to see if you have a close within the chop and certainly a close below the low of this bar. Very, very significant signs. A pullback and then a resumption certainly could be well expected, and that resumption could easily take us up into the 2000 area without too much of a challenge. If you look at the S&P futures, you can see we've had something of a pullback so far, but again, relatively minor given the size and proportion of that candle. When we look at the Nasdaq, or let's go to the Dow first here, very similar pattern here, but notice how it's kind of coming into these resistance areas. Nasdaq, now its breakout was nowhere near as convincing as the others, but it still is a very bullish action on Friday, and it did close above all that prior chop. And then the Russell, very clear breakout above the chop, but as you can see, there's just a whale of lines above that to run into resistance and slow this pattern down. We could go into a pattern with all these indices of lower volume but incremental bullishness. That is frankly a normal bullish pattern, so it would not be unexpected. course, the VIX is starting to really come down. It's up a little bit this morning, of course, with the S&P futures being down some 15 points. So it's running around a 22, so still elevated. You know, this is not the land of bulls. The land of bulls is down here 18 to 12. And so this is not a friendly, benign kind of bullish market as of yet. And we'll see more of that as we look at the daily report. Bonds coming down a little bit, but at the same time, you know, this was a pretty significant price action in recent days as it's kind of come up against, you know, what would be at one point was basically a triple top, and it's starting to probe, breaking through that. Now with today's action, you know, coming down, that would likely give some impetus. Now we had a big move in bonds on Friday, and they may be doing some digestion itself. Okay, in terms of the daily report, I mentioned briefly that, you know, there's still a lot of risk, and there is. Just because we have one great big bullish day, and whether it's one or two standard deviations, doesn't heal all the damage that we have had to date. In terms of the market trend intermediate term phase opinion, we're still phase one, but just barely. We met all but one of the criteria to take this to phase two, and really, you could call this a, you know, 1+ almost for certain. If we get a decent amount of price action follow through, at least a day or two, would be all it would take to be able to say that this is phase two, I would expect. So I'm watching this very closely. I'm expecting this to change to phase two, which would be a much lesser risk and would start to open us up for more initiation of various strategies, and more bullish posture if that were to happen. IBD, of course, has signaled this correctly so far as a confirmed uptrend, though the accumulation distribution score in the S&P is still a miserable E, and the Nasdaq also that same E. GMI index is still at a full out 0 out of 6 with a sell signal since 1210, and that author retains a 100% cash status. And then you look at the decision point scoreboard from stock charts, we still see a sea of red arrows. There's not a green arrow anywhere on any index on any time frame. So when you put all this together and you look for some consensus, that consensus is that we are a very, very weak market, and that when you look at the intermediate term market posture, while it's bullish, it has a very bearish sentiment line. So the longer moves, the longer legs are expected to be bearish legs, and the shorter moves are expected to be bullish moves. So that would seem to run very contrary to Friday's action. That's part of what I'm trying to pull out to you here today, is that while Friday's action was significant, and when we look at this pattern since the reversal bottom, and so we had this reversal pattern here, which was confirmed. We had a diagonal resistance breakout, with that then denigrated into some chop, but then that then broke out on last Friday. You know, this looks to be at this point at least a short-term capitulation and reversal pattern, which has had multiple confirmations now. That being said, because of the damage that was done, our systems here are still very, very negative. And it remains to be seen is, do we just simply have something of a short-term bullish bounce? And remember, bullish rallies can be very significant in bear markets, just to then leg down a whole nother leg. So that's really the open question at this point, is all these mechanical signals, are they indeed the correct signals? And this is just a kind of counter trend move within a much larger pattern. In terms of that intermediate term market posture, you see that we are indeed bullish, and you know, these are climbing up above those minimum 20 readings and starting to head towards 50. We've got some work to do to get to 50, but they're all solidly in the bullish camp. All four of them are in the bullish camp, though we still retain that very bearish sentiment line. Position sizing opinions remain at 100% and at that 50 to 75% coming from the two different models to give us those opinions. Hedge warning status has dropped to level 1 from the 1 plus. This is a yellow light. This is to say caution. There is some elevated risk in the market, and the potential for downward moves or even large downward moves still exist in this market. We are not yet a healthy bull market, and indeed you see on the stock short-term risk pretty high 8 rating, and then the medium term much more benign, a 5. In terms of special risk assessments, you see a lot of this has turned back to black. This was a sea of red just a few days ago, so we have started to see some improvement here. Really only the VIX futures up over 18 as of note. And in terms of the intermarket risk aversion indicators, we now have only 2 of the 5 are still flagging as risk off. Our fear and greed index is up to a 26. So, there's fear, but we're not in the extreme area anymore. And you see from a week ago, it's all the way down to a 13. So this is definitely improved. In terms of special opinions and in terms of option income strategies, the VIX is still outside the acceptable window to initiate new positions for novice traders. Now, more aggressive traders will want to take advantage of these improving conditions while still having some elevated volatility, which will afford you to have greater premium given to you in return for taking that risk. You take that risk knowing that delta and vega moves could be larger than normal in bull markets, and that you have to be prepared to accept that risk and be ready with the capital and other tactics to be able to make adjustments. In terms of cover call strategies and put selling, conditions are now acceptable to initiate new positions for novice traders. You might want to use a range of defensive strategies, and some of those might be using a 0 to 1 ratio. So that would mean that no out of the money, only in the money strikes for active positions. If you're going to initiate a position, structuring it in such a way that it's very defensive, giving you maximal downside opportunity to be able to still profit while still at the same time being able to take advantage of these elevated premium levels and start building some positions. Also, in terms of high beta, low beta, you might want to use a lot more low beta positions than higher beta positions. You might want to consider legging into positions using these conservative setups, using well out of the money put selling. You might also want to consider reduced position size, and then as this pattern proves itself out, then you scale into more size. In terms of sector specific, you see quite a bit of improvement here as well. Our short to intermediate term especially is not a sea of red anymore, with the exception of healthcare, and this seems to be mostly from the biotech that is dragging that sector down. Of note is utilities and the consumer staples. So note that most of this action thus far with this bullishness and this breakout have been in the defensive areas. So that is not super strong statement about just how confident the institutions are about this breakout, that they're loading up on those areas that are more defensive in nature and will likely withstand better any kind of future weakness in the market. They're not loading up so much on the higher beta areas. In terms of percent change, you see information technology, materials, financials, industrials. There was a big move as percent change in some of these areas on a Friday. Utilities, of course, also up though strongly as well. In the relative rotation graph, we continue to see the areas that are performing the best are those which are interest rate sensitive. IYR, XLU, many people would have thought that these would be absolutely dismal this year, given that the interest rates were expected to be, impacted by Fed decisions. Well, that's not turned out to be the case at all so far. TLT, XLU, IYR are all doing quite well thus far based on their performance from the first of the year, and expectations that the Fed is going to be raising interest rates anytime soon, as they had earlier communicated, would seem to be priced way down in terms of probabilities now. So many people are indeed investing their capital into these more defensive areas, looking for the certainty of solid dividends over the exposure to higher beta, more growth oriented, and stock appreciation kind of tactics. So that's also of some note. Well, that should be enough for today. As always, if you'd like to get emails from Falcon Global, there's two different ways to quickly sign up. One is to go to this website, scroll down just a little bit, get to this button, click the button, and that'll take your name and email address. You'll get a hyperlink that'll get you access to the ebook Portfolio Strategy. If you want to use your smartphone, you can text Falcon Global to this number here, and that will also get you signed up, as well as get you the ebook. When you sign up, that of course gets you a very limited number of emails. We're very cautious with how many we send out. At the same time, we generally send these out when we got a change in hedge risk level or periodic blog articles or other items of interest. If you find that what you're getting from here is helpful to your trading, we would ask that you subscribe to the YouTube channel. We're right at 150, a pretty amazing number of subscribers, given that we've only been at this for a relatively short period of time. Clearly people are finding this of use. If you do, subscribe to the channel. That gives you a notice when the content is published. You can also retweet us to your Twitter followers, to your StockTwit followers. Also a welcome note to us that you're finding this of use. I'm just going to scroll through the rest of this. We've gone long enough today. Disclaimers as always, hit the pause button if you need more time to review. You see the hyperlink at the bottom for the full set of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.